9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne with Annabelle Jewelers.
We're counting down to the open of markets in Greater China, and our top stories this morning. We have Asian stocks falling for a third day. Korea is very much leading the losses. Oil as well, Brent crude just coming online, and you're seeing it sort of steadying somewhat. Investors really weighing this U.S. plan to ensure escort tankers as well passing through the Strait of Hormuz.
China's foreign minister urging an immediate ceasefire in a call with his Israeli counterpart, while questions mount over U.S. objectives in the war with Iran.
Also ahead, leaders of Wall Street's biggest private market players warn investors have reason to worry amid a wave of withdrawals.
And I'm Stephen Engel in Beijing, where China's most important political gatherings are about to begin later today. Officials will unveil the 15th five-year plan, including a goal to spur a significant increase in consumption.
We were hoping for some sort of relief rally. We certainly saw that in the U.S. Not quite the case when it comes to Asia. Things seem to be fading, especially when it comes to risk assets like equities here this morning. Korea continues to see a lot of pain here. Oil markets, as you mentioned, have steadied in some ways, given some of the assurances that we're getting from President Trump when it comes to oil and tanker escorts here through the Strait of Hormuz. But still, a lot of risk involved in and how this is going to get implemented as well, though.
Yeah, I think that our geoeconomics team had a really fascinating analysis on this idea that they can essentially reopen the Strait of Hormuz. There's a lot of different costs in equipment, resources, commercial vessels as well. I mean, this is a very difficult, very challenging task. And I guess oil traders, again, still really trying to assess that because you're seeing Brent crude very much steady as we come online this morning.
Yeah, you know, there are going to be risks to how it works, how they're going to be doing this. Obviously, it's not going to be something that's very swift, and, you know, oil flows are going to resume in the Strait of Hormuz anytime soon because there is still this risk, they say, of maybe drones in that waterway there that could be attacking tankers as well. So that certainly is one thing that we're seeing and we're digesting across these markets. But right now, that knee-jerk reaction still is to sell right now. And we're not quite seeing that much dip buying as of yet. We continue to watch, of course, the market impact. And what President Trump says was he still believes that oil prices will drop once the war with Iran is over.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
Well, let's take a look at the market reaction to this, because as we said, it really is traders just trying to understand the nuances of this U.S. plan to escort vessels through the Strait of Hormuz. You are just seeing, again, Brent crude, WTI, fairly steady this morning, but we are really seeing the implications. For instance, Iraq has started to cut its oil production as well. And this is, you're talking about OPEC's second biggest producer here. So clearly these ramifications are wide, and you've seen that very notably in European gas futures as well, which have absolutely surged. So we're leaving that reaction there. Gold, of course, is one to watch, given you're seeing that flow back into safe havens. But certainly the dollar is very much reflecting that as well. We'll get to FX moves in a moment. Safe to say, though, you are just seeing traders that are very much pulling back. From the Kospi in particular, we've actually seen it now extending its fall from its Feb 26 high to more than 10%. The big laggards there are the chip players, so SK Hynix, Samsung, of course. We talk a lot about the Kospi too, essentially, but you are just seeing that under pressure. Taiwan just coming online more than 2% to the downside. As I said, very much that story is in FX as well. You have seen the dollar really sort of reclaiming its safe haven status, the sort of ultimate safe haven play as well, but certainly stifling those debasement trades or debasement fears we've seen really around the issues or whether we'd actually continue to see it operating as a safe haven trade. But very much you are just seeing it again moving against its major peers, Korean or Chinese equities rather, because of course we're looking ahead to the open. Very interesting timing for an MPC to be kicking off when you have all of these geopolitical concerns and certainly China trying to ignite the consumption story in the country as well. But we're going to get these growth targets later Thursday, 5-year plan at the end of next week.
Yeah, the timing of this MPC is quite interesting, right? It's weeks away from a meeting with Trump that President Xi is going to have, and it's in the midst of this whole Iran situation. So certainly how they're going to be boosting or at least talking about domestic issues is going to be a key thing to watch, especially when it comes to self-sufficiency, right? Now that you talk about disruptions in supplies around the world, that might be creating a bit more emphasis for China here this time around. For more on the Middle East situation, let's bring in our politics editor, Laura Davison. She's with us here right now. So this whole plan to help escort and insure tankers from the U.S., to what extent do you think that really calms some of the nerves that we're seeing across maybe oil traders and the like right now?
You just have to see markets. There was sort of an initial reaction and then things kind of flattened out.
Right.
What we're seeing from Washington right now is a lot of graspings for solutions without a lot of clarity about how these will actually come to pass. You know, Trump mentioned he invoked the Development Finance Corporation, which is sort of a quasi-agency in the U.S. They don't do insurance. This is not something that they have an off-the-shelf program they can just sort of get up and start running. They would need to figure out the risk. They would need to price these. They would need to, get the whole infrastructure of this up and running. This is something that could take weeks or months, so that's not a quick fix solution here. Trump also suggested the U.S. military could help escort, though if there are drones or other sort of threats in the region, unclear exactly how willing the U.S. would be able to commit to that, also while waging a war separately.
What I find fascinating as well is President Trump's comments around who could be the next leader. And he's saying it could be someone who's just as bad, essentially. I mean, if the whole idea isn't around regime change, what actually is the rationale and his ultimate objective then?
This is really unclear. We seem to have the president really in real time in public grappling with what the next steps look like. Just 2 days ago, he said he had identified 3 people he thought would be good leaders of Iran. Then just a couple hours later says that, actually all of those are dead. So we need to come up with other options. And now saying that he, kind of at least acknowledging that he may not get to pick here, that this is not, he doesn't get a vote. There's sort of a 3-person committee running the country right now. Iran will make that decision. But there doesn't seem to be any sort of coherent strategy that the White House has articulated. We've heard different things from Vance, from Rubio, from the president himself, even day to day on, exactly what the goal is, what the end game is. We even heard Trump, who really campaigned and rose to political prominence, saying that he wanted to end forever wars, saying in the Oval Office today that this war could be fought forever if it needed to be.
All right, Laura, thanks very much for joining us. Of course, a lot to unpack and a lot of threads that we can continue to digest. But that was our politics editor, Laura Davidson, there. And let's get more on the markets. Bring in George Efstathopoulos now. He's portfolio manager at Fidelity International. And I think people are really still coming to terms with I guess, how long-lasting and the sort of permanency or lack of. What are you making of the conflict so far? Because, of course, we're well into, fourth day now.
Yeah, absolutely, Shane. Good morning. I guess we've seen it. I think what a lot we've seen when it comes to markets has been positioning. Of course, a lot of markets have done very, very well sort of year to date in the past couple of years. So we're seeing a bit of positioning sort of lightening, but at the same time, I would argue depends on how protracted this ends up being. Underlying fundamentals are still sort of resilient, because if we look at what's been going on, if we exclude the past few days, essentially global growth was on a very strong footing. We've had financial conditions being very, very easy. We've had US growth very strong. We've had fiscal happening around the world, in the US, in Germany, one of the biggest fiscal hawks around the world, even in places like Japan, and now most likely, we have to wait to see what happens tomorrow, but potentially sort of also a bit more fiscal coming from China. So we have to wait and see if this gets protracted or not. I know, kind of like everyone else, we've all been seeing all these historical analysis in terms of what this could mean. I'm not a political analyst, and no one has the crystal ball, but there are some mitigating factors versus sort of historical parallels. Mm-hmm. Some of them are, for instance, in the past, this time around, essentially, it's sort of one actor versus all other actors in the Middle East. The rest of the actors in the Middle East actually won the situation, resolved a lot faster. Mm-hmm. This is something that's significantly different in the past. OPEC coming together to essentially bring more supply. Again, sort of this is sort of a positive story. US, compared to 20, 30, 40 years ago, US is a net oil exporter. Mm-hmm. Vastly different situation versus the past. And not only that, you could argue they have some semi-leverage towards sort of what's going on in Venezuela. In Venezuela, supply, again, something that wasn't there in the past. China's been very much in the news when it comes to, China is the biggest oil importer in the world, but they do they've been building up the reserves sort of day by day, month on month, sort of the past sort of a year plus, and they have more than 200 days of consumption. And also, if you look at the energy sort of combination in terms of sort of what really matters, oil is about 20% of their energy consumption, and they rely on coal, and they've been transitioning a lot more towards green energy. I think what an interesting story would have been had China not done this. Perhaps things would have been quite different. And one last point also on China. China still has this inflation and deflation issues. This would have been a very different story for China if we were coming into this at a time when inflation in China was very, very strong. Inflation in the US is a lot stronger. And we've got the midterms election in the US. So, there's clearly probably some... we have to take this into consideration in terms of Trump and the policy sort of makers over there need probably to have this already also faster.
So are you concerned that the spike in oil prices could reignite some sort of inflation concerns? Because it seems like it's not just oil prices or energy, right? You're talking about even before this Iran conflict, we saw precious metals have been, soaring higher. You're talking about industrial metals that continue to have done well as well. So is this time a bit different in terms of the inflationary shocks that we could get?
A few answers to this. Before the weekend, I would have said that most likely sort of yields can go up because global growth is actually in solid footing, and governments are spending, fiscal deficits are rising, productivity gains from AI. So one could argue that actually, where yields were, they could move. The R-star, etc., could have moved a little bit higher. Clearly now, with the developments, if this ends up being sustained, the initial reaction will be what does this mean for inflation? What does this mean for inflation expectations? Typically, when you look at U.S. inflation expectations, they move a lot with what happens in oil. So, of course, we have seen the reaction when it comes to treasuries, and across the curve, yields are up, whether you look in the US or whether you look sort of elsewhere around the world. So we are seeing sort of this inflationary reaction. But having said that, this is more of a short-term shock for the time being because a lot of the action in energy markets is focused on the on spot and the front end. If you look at beyond sort of the front end, actually things are still a little bit more calm. And I've also seen comparisons, for instance, to 2022, the Ukraine-Russia conflict, right? But back then, I would argue again a little bit different because that was the world essentially moving away from a big energy supplier. Whereas this time around, again, the rest of the Middle East, once it's resolved, and potentially if you want a positive spin, one could argue that even if and when this gets resolved, potentially more supply comes back to market.
Sure. There are the FX complications, though, particularly for Asia. We've got major economies here that are net oil importers, but which ones are most vulnerable, do you think?
Typically, one would have argued that China is more vulnerable because again, China is the biggest oil importer, and a lot of the what passes through the Hormuz Straits does go to China. But as I mentioned before, for China has been very much diversifying its energy resources. Coal is a big component of what they do, and even when it comes to powering the country, it's mostly driven by coal, and it's mostly driven by wind and other sources of energy. Whereas if I look at other markets, for instance, Southeast Asia, for instance, perhaps a bit more vulnerability in that part of the market.
I remember a few weeks ago, there was a story that came out that you guys actually sold your gold before that big crash that happened. What do I do with gold now in the face of all these geopolitical
We
issues?
sold because just gold had moved very fast, very quickly, and we just thought it was a bit sensible to just take some profits. We had used that soon after we had used that correction to buy back a bit of gold because the long-term the mid to long-term structural theme is still there. Why has gold been finding a bid for the past Yet, despite the correction we saw yesterday, and I think gold is up today, gold is still up almost 20% for the year, and we all know where it's gone last year. What are the structural drivers, structural themes here? Essentially, the US has been easing in a cyclical reacceleration. US is spending, fiscal deficits are rising, and it's not just the US. Again, as I mentioned before, Germany is spending, Japan is spending, most likely China is going to be doing a bit more spending as well. So global deficits are on the rise, fiscal spending is on the rise, and the other component is just look at what bonds have done the past 2-3 days. Historically, one would have gone to bonds for that risk off, but actually bonds have sold off on a risk-adjusted basis, probably as poorly as equities, and as a result, it's a time when we focus more on safe havens like gold and other real assets, and gold fulfills that part of the equation.
George, do stay with us because we're going to have more with you in just a few minutes. That's George Efstathopoulos, their portfolio manager at Fidelity International, and just counting down, of course, to the open of trade.
Yeah, we also got a bunch of PMIs coming out out of China too. This is not just the official gauge, but also that rating down private gauge as well. So it's rare to kind of see them all coming there, but maybe it's because it's the day before MPC. So certainly that's one thing to watch. We talk about correction territory for H shares as well, 690 for dollar China. You're still seeing that weakness in the currency, given the dollar has had the best two-day rally in nearly a year, given some of these safe haven flows and the like. And of course, we still have that press conference happening for the MPC, that CPPCC opening ceremony to watch out for here as well.
Yeah, and some of the sectors we're watching, we've got defence, energy, materials among the ones that we're watching. And just to note on, as we, of course, mark that, we do actually have a report coming out from Reuters as well. Interesting, because we have President Trump saying that the US has the stockpiles essentially to fight a protracted conflict. At the same time, there could be a little bit of urgency in Washington to shore up weapons stocks. And to that effort, Reuters is reporting that the Trump administration will be meeting with executives from the biggest US defense contractors at the White House this coming Friday.
Okay, so there you go. More assurances potentially from the US here today on how they kind of deal with this fallout when it comes to defense, when it comes to energy, when it comes to oil and the like. PMIs are out here, as we talked about. This is what we're expecting. So it's not going to be a good print, just given that it was a 9-day holiday during the Lunar New Year, though. So we are expecting a second month of contraction there when it comes to manufacturing, non-manufacturing as well. 49.7 is that estimate. We'll break those numbers to you at the bottom of this hour. This is the China Show.
Taking a look at futures ahead of the open here, about 10 minutes or just over away. We are looking like we're going to be really swept up in the mood across Asian equities today, which is risk off, of course, for a third straight session. Also tracking the yuan reference rate. This is an interesting one, actually, because we've actually seen the difference between the actual and the estimated fixing narrowing over the past few sessions. So analysts are saying, you know what, maybe this just means the PBOC is actually kind of comfortable with where the yuan is at right now.
I was going to say, maybe the fact that the dollar is coming back on the back of this whole Iran situation might be something that they want, right? Is to really kind of stem the appreciation of the renminbi. 692, that's quite weak for the currency right now. But as you see with futures, I mean, those are some pronounced moves in terms of what could have happened here. It could be, of course, another catch down story for equities here today. And we're looking at oil prices as well after President Trump's plan to provide naval escorts for shipping in the Persian Gulf and Strait of Hormuz. Now, Washington also says it may insure those vessels if necessary. Let's bring in Stephen Sapchinsky, who heads our energy coverage in the region. Stephen, when you saw a headline like that, I'm just wondering what went through your mind.
I thought, hey, maybe things are going to get better. But I think there are more questions than answers right now, right? I think the Strait of Hormuz is clearly a choke point that is that is one of the things that has helped to push oil and gas prices higher. Travel through that region or through that waterway has essentially halted for both oil and gas tankers. So, if they get some guarantees, great. Will they resume traffic? How do the guarantees work out? What about insurance rates, right? The U.S. said that they could even help with insurance. How does that work out? What are the prices? There are so many unknowns. There are more unknowns than no knowns at the moment. And so because of that, I think you didn't see the big reaction in oil prices. I woke up from my bed, I saw that headline, I said, hey, maybe we're going to see a huge drop in oil or something. But no, the market didn't react because they need to see something tangible. So I think until you see those ships start to move again, you're not really going to see that reaction.
And I guess at the same time, a producer like Iraq, for instance, has already started to curtail production. So which one do you think wins out here? An obvious, like the OPEC's second biggest producer that's reducing its output versus this assurance from the US? And where do we go in the near term, do you think?
You raise a really good point here, right? The Strait of Hormuz is one problem, and quite frankly, it's one that could be resolved relatively quickly. If there's a peace deal, if there are assurances from the U.S., if insurance companies are able to provide rates that work for the ship owners, great. travel, resumes, and you're getting those ships through the waterway. The other thing is the infrastructure. If there is damage to the infrastructure, even if there is a peace deal, how long does it take to repair things? What are the chances that it could get hit again if there is a flare-up between the U.S. and Iran after there's a peace deal, right? This isn't over. It's opened up a Pandora's box. So I think, yes, the market right now is focused on the physical barrels, and it isn't looking great. Large refineries have been hit, the largest in Saudi Arabia. Iraq is reducing their output. You've got the world's biggest liquefied natural gas facility offline. The one in Qatar provides 20% of LNG to the market, and it is offline right now. Unprecedented, all 14 trains. So with all that in mind, the market is looking at that as well. And the big question, which I wrote about yesterday in our Energy Daily, is how long do these outages last? Because we're really in uncharted territories.
Yeah, we still don't have the answer to that. China, the biggest importer, of course, of Qatari LNG. There are analysts out there, Stephen, that say maybe this sort of what we're seeing here, the impact could be short-lived because China has diversified away from LNG, right? They can easily, switch to hydropower. They can switch to solar. They can switch to coal, for example. Does it make it as a bit of a cushion there, at least, that China has alternatives?
Yeah, I think when you look at the array of Qatari LNG buyers, even though Qatar is the world's biggest buyer of Qatari LNG, they do have other alternatives. Now, for days or weeks, sure. We're in a low demand period. Total LNG imports into Qatar, into China in February was the lowest level in years. So their demand is relatively weak. They can get over this. And quite frankly, in the near term, with prices spiking in Europe, I bet they would love to resell their shipments to customers that are willing to pay double the price than we were last week. But if this continues, you have to remember that China gets 30% of their LNG from Qatar. Replacing that will have to be a priority at some point as we get into the period later this year when they're restocking their supplies, when summer comes. So, it's again a question of how long does this outage last? I think countries that are more exposed are maybe in South Asia, which Bloomberg NEF kind of highlighted. We're talking India. India's already reducing gas supplies to industries. Pakistan buys 99% of their LNG from Qatar. Bangladesh as well needs it for fertilizer. So those are the ones to watch, I think.
Steve, great to have you with us this morning. That was Stephen Sapchinsky there, who leads our Asia energy coverage, joining us from Singapore. Quick check of markets as we go to break. We are certainly seeing a big risk-off session continuing to develop here. We've got the broader Asian gauge off 3%. Kospi is leading the losses, but of course, mainland Chinese markets also looking to get swept up in the mood. More ahead. This is Bloomberg. Welcome back. You're watching the China Show this morning, counting down to the open of markets, and it is very much risk off across the board. I think really if there's one market that's taking the brunt, it's the Kospi. Yeah. You're already in technical correction off more than 10% since the high back in February of this year, but really very broad-based selling we're seeing in the session.
You're starting to see that Asia is a bit more vulnerable to some of these headlines than maybe the U.S. in some ways, given maybe there was, the beneficiary of this whole AI trade, which now is also in some ways in question as well. Because you think about some of these AI growth technologies, they do need cheap energy. They do need that sort of all those materials to really kind of fund their technology. So is that in some ways a growth sort of impact as well? What does it mean for AI investment moving forward if we see a prolonged sort of conflict and energy prices continue to stay elevated? But right now we're still talking about, the whole prospect of, oil tanker escorts and the like. That has in some ways just a little bit eased off, right? We were briefly hitting $85 for Brent. We've come off that just slightly, but we're still seeing their Shanghai crude is still looking pretty strong. We're still up some close to 14% for futures in Shanghai. You are starting to see copper actually come off as well. So the potential hit to inflation, the hit to growth certainly is one thing to watch out for. You are seeing most of these large caps are selling. CATL is down some 1% right now. And Shanghai Composite, we are just hitting that 4,000 psychological level once again. So there you go. We're watching very closely whether onshore is that place to park your money. When you take a look at what mainland investors have been doing, even in the ETF market, there was a great story that came out in February that they were still buying up a lot of some of these Hong Kong ETFs. And maybe, when it comes to the southbound flows, maybe things are looking a little bit better than maybe just from a week ago. You have your PMI numbers coming through here. Oh, and it seems like for now, the official numbers is a miss. 49 for manufacturing PMI. And that is coming off of a slower than what we saw the previous month, 49.3. Non-manufacturing, also 49.5. Also a miss there, Bill.
Yeah, exactly. I do think there's sort of the seasonality factor, of course, because February had the Lunar New Year holiday. It was a very long one at 9 days. But you have seen that contraction now for a second straight month. Will be interesting, of course, because we get the private survey coming out in about 15 minutes from now. So do you sort of see a divergence? Also, some headlines crossing around the CIA station in Saudi Arabia. But it does seem, at least in the Wall Street Journal, they're saying that it's been hit in an Iranian drone strike. No casualties at that site. What the Wall Street Journal again is reporting this morning.
So, the crossfires that we're seeing in the Middle East, that still is something that is keeping investors in some ways spooked. As you talked about, that no CIA personnel wounded in this Iranian drone strike, according to the Wall Street Journal. But you take a look when it comes to the Hang Seng, right? We're seeing those Hong Kong markets still continue to see some pronounced selling here. We're down some 2%. It seems like there's still a lot of falling knives out there when it comes to equity side of things and really how long these disruptions are going to occur. But yes, we're not seeing the relief rally in some ways that we saw in the U.S. here right now. Dollar China is on the weaker side. We're at 693 levels here right now. The tech space is falling substantially here. Take a look at Alibaba. We're down some 3%. Meituan's also down close to 3%. Xiaomi is a standout there, although Jefferies just came out with an analyst note also talking about the margin pressures when it came to memory and the like. Certainly is something that they're flagging as well. HSBC as well. So the banks, obviously there is the exposure, whether it's the Middle East exposure, whether it is the thought of maybe that central banks now might not be able to cut rates, that certainly is impacting the financials here. So we're down to 4% losses when it comes to HSBC. Property also in Hong Kong down some 3%.
Yeah. All right. Let's get to as well what is the big story in China, because it is the most important political gathering of the year. It begins today. Officials are set to unveil their blueprint for growth through the end of the decade. Let's bring in our Chief North Asia correspondent, Stephen Engel, who joins us now from Beijing. And Steve, talk us through the agenda. What exactly are we expecting to hear today and also tomorrow, of course?
Yeah, so it's a highly choreographed affair, the National People's Congress, which begins tomorrow morning. This afternoon over at the Great Hall of the People is going to be the CPPCC. It's a mouthful, yes. It's the advisory body, larger advisory body to the NPC. They start their gathering a day earlier. Then tomorrow morning from the Premier, Li Qiang is going to give his annual work report. We're expecting a less rigid growth target for 2026. Last year it was around 5%, and despite the Trump tariffs, they did hit that number. We're hearing, though, that the target could be sort of a range instead of a round, if that makes any sense. What that gives the policymakers is more flexibility. So if they have a range of between 4.5% and 5%, they can hit that anywhere between those brackets, and it gives them flexibility. We're also going to get, of course, the budget deficit number. It's expected not to increase. It should be around that record high of around 4%. There's less urgency right now to stimulate stimulate the economy. The biggest urgency, not only in this year's targets, but in the next 5-year plan, which is also being ratified or codified by the National People's Congress, which will run through 2030, and that is boost domestic consumption. Xi Jinping is already out with 2 different speeches since December saying boosting a significant boost to domestic consumption is going to be the main priority in the next 5-year plan, which will be formalized again over the next week or so. Lots of uncertainty, though, geopolitically, given the situation in Iran right now, which throws kind of more uncertainty with what the messaging is going to be. I said the NPC is a highly choreographed affair, but this is really the one time that we get to really get a sense of how the Chinese top leadership is thinking. There's going to be a press conference likely over this coming weekend with the foreign minister, Wang. He's been pretty outspoken about what's happened in Tehran. And we're also going to get another press conference with the 5 main economic leaders. So we're talking the central bank governor, the Ministry of Finance, the finance minister, the commerce minister, the NDRC, and others. So it's going to be a pretty busy week.
Steve, you mentioned about the external picture is looking quite interesting and a bit more complicated, right? We're hearing some reports that the trade chiefs from both sides, the U.S. and China, are still looking to meet in a few weeks or so. Does that still lay the groundwork that President Trump and Xi are going to meet in a few weeks as well?
Yeah, I think they need to kind of come up with the deliverables. And I think what's happened, obviously, over this last weekend in Iran has sort of changed the dynamic of this summit coming up, if indeed it happens at all. I think there should be some questions about whether Xi Jinping will still invite Donald Trump, given how close Iran and China are. And again, so we're hearing from sources that the main trade negotiators, so we're talking about He Lifeng on the Chinese side, and then Jameson Greer and Scott Bessent will be meeting next week, perhaps in Paris, to have sort of a final dash, a final round of talks to find the deliverables, because the Chinese want to have a choreographed state visit of Donald Trump. They want to be able to announce something that suits their needs. The Trump administration wants the same thing, too. But again, the Iran situation has thrown up a lot of question marks about geopolitical situation going forward. In fact, of course, Wang Yi, the foreign minister, has been talking a lot about the Straits of Hormuz. We all know that Iran sent about upwards of 90%, depending on the month, of its oil exports to China. And also in December, about half of China's oil imports for December went through the Strait of Hormuz. And Wang Yi has been talking about, making sure that those shipments are going to be safeguarded.
Steve. Thank you. Stephen Engel there, our chief North Asia correspondent, joining us out of Beijing here this morning. Still with us is George Efstathopoulos, portfolio manager at Fidelity International. In terms of your wish list for MPC, is there anything that you're looking out for?
The wish list is a rebalance of the economy more towards sort of domestic consumption. It's something that we have been hearing from leadership, from the Chinese policymakers, and when they talk, I tend to listen. It might not be happening at a speed that investors would typically like to, but I think it will be happening sort of gradually. And as kind of discussed already, China has 2 key growth engines. One has been going in overdrive. The other one has been underperforming. Of course, one is the export market. The other one is the domestic sort of consumption. The export market, the big story of 2025 of last year was the resilience of the export market that had potential sort of shift a lot of the dynamics when it comes to how the rest of the world sort of used China. So for me, that resilience has been quite important. And more recently, if anything, with the Supreme Court ruling, if anything, tariffs for Chinese goods have actually come down. So that's another boost for the exports. But China still needs to rebalance its economy if it wants to sustainably essentially bring the economy out of deflation, disinflationary pressures. And not only that, I think another kind of interesting dimension here is that China holds the fiscal keys not only to rebalance its own economy, but at the time when perhaps the U.S. has become somewhat of a less reliable trading partner, they can come in. Why does the world look always to the U.S.? They look at the U.S. because the U.S. has the biggest consumption story where global consumption, U.S. consumption is the biggest number in the world. China undershoots on that front. And if they were to do that, that also helps with the renminbi, which is another story that we've heard Chinese policymakers sort of talking up. Domestic consumption, stronger yuan. If we see more fiscal stimulus happening in that sense, we could put two birds with one stone.
Are you concerned, though, about the health of the consumer? I'm talking globally here for this year at all.
Again, before the weekend news, a lot less so. If anything, I would have said sort of quite strong because, again, we're seeing fiscal stimulus happening everywhere. We're seeing kind of in the U.S., we're seeing sort of cuts, interest rate cuts at a time when the rest of the economy is seeing a cyclical acceleration. We're seeing the one big beautiful bill, which is essentially a tax cut for U.S. consumers. We're seeing fiscal in Japan. We're seeing fiscal in Germany. So I would have said that the consumer, the global consumer, is actually on a strong footing. We have to see how the developments of the past few days changes that from an inflation energy tax perspective. So we have to wait and see how that looks. But broadly speaking, before that, I would have said sort of global consumption looks strong. And if China also helps on that front, I would say even more so.
What looks safe to you now? I'm just wondering, up until now, Asia seemed to be more resilient given the AI story. I mean, HS Tech have also, there's been a lot of concerns about software and the like, but now that things are kind of fleshing out a bit, Korea is selling off quite massively. I mean, are there opportunities that are opening up for you now, George?
So, you guys mentioned earlier, Asia's starting to look a bit more vulnerable, but I would bring this back to its positioning, it's not fundamentals. Because, why am I saying positioning? US equity market year to date is down, driven by mostly sort of software stocks. To most people's surprise, software stocks have been up the past 2 days. So to me, that's about positioning because they've been very heavily sold off. And of course, we've seen Korea and other markets sort of correct quite meaningfully. But let's not forget, Korea, past the past couple of days we've seen the correction, is still up 40+%. And versus last year, again, the best performing market. So I'd say this is a positioning sort of situation. And if we look, follow the money, one of our sort of big themes on our end is follow the AI CapEx spend, which is coming from the US into Taiwan and into Korea. Follow the money. The demand-supply dynamics are looking very, very attractive. And if anything, also, when you look at Korea and other places in Asia, we're seeing more corporate reforms. We're seeing more buybacks. We're seeing high dividend payouts. Ironically, the US has been the strong market in recent years about buybacks. That's where we've seen, a big chunk of sort of free cash flow going into buybacks. That's now coming down. It used to be 45% 3 years ago. It's now 15% last year and coming down further. Now about 90% of free cash flow is going to CapEx. Where is that CapEx going? That CapEx is all going to Korea, to Taiwan. So the fundamentals are still very, very strong. From that perspective, it's a positioning situation, less so fundamentals. Could the fundamentals change? Of course, if recession happens, that's a different story. But for the time being, US has been more resilient, and US is a net oil exporter. So I don't expect that to meaningfully change the year situation, which means fundamentals for Korea and Taiwan remains attractive, and this potentially could be a buying opportunity. But again, Korea is still up 40-50% year to date. Yeah,
it's a very interesting sort of strategy that's evolved of software stocks up, but AI trade down, and then the counter. It's an interesting dynamic in the markets right now. George, thanks very much for joining us. That was George Efstathopoulos, their portfolio manager at Fidelity International. Just need to also clarify that reporting we had from the Wall Street Journal, that is an Iranian drone strike hitting a CIA station Monday at the US Embassy in Riyadh in Saudi Arabia, again, according to their sources there. But that strike, not a new one that took place early this week.
All right, we have plenty more coming up when it comes to the Iran situation and check markets coming up over this break. After this break, this is Bloomberg.
Chinese Foreign Minister Wang is calling on Israel to pursue an immediate ceasefire in Iran. He spoke with his Israeli counterpart on Tuesday and said Beijing will play a constructive role in easing regional tensions. Wang also urged Israel to take steps to ensure the safety of Chinese citizens and entities.
Our next guest says that China is concerned about energy supply disruptions caused by rising oil prices. Joining us now from Shanghai is Zhang Chuchu, Deputy Director of Center for Middle Eastern Studies at Fudan University. Chuchu, it's great to have you. Everyone's been kind of talking about the role that China may have in this sort of Iran conflict. What do you see what Beijing could do?
Right. Actually, I would say China is deeply shocked by the trampling of international law and rules and the disregard for humanitarian disaster. And moreover, currently we can see that there is the spillover effect of this conflict because there is recent attack on Lebanon, and that indicates that the geographical scope of the conflict is expanding at the moment, which will have a huge impact on the economy and people's livelihoods in the Middle East in general. So I think, of course, China would very much hope that this conflict will be de-escalated. But I think it's not just China, but the entire international community would like to see a de-escalation of the conflict as soon as possible, and that peace and stability can be restored to the region.
What is China's ability, though, do you think, to project any sort of influence in the region? We saw, of course, that it really didn't have very much sway at all with the US capture of Nicolas Maduro in Venezuela. It seems like a similar situation somewhat with what's happening today, again, in the Middle East.
Right. I think a very important assumption when people are saying so is because they think that China is an ally of somebody. But actually, according to China's foreign policy, China holds a non-aligned policy. So it means that China does not have any military ally. And actually, in the Middle East, China has consistently adhered to a neutral stance in the Middle East. And currently, we can see that right now it's already so the war has a spillover effect, and it has already affected many countries in the region. And as for China, it always tries to adopt a balanced position and try to adhere to a neutral stance in order to maintain good relations with all of the Middle Eastern countries. And I think what we are currently witnessing is a conflict between the United States and Iran. So those countries, the United States, Israel, and Iran, the negotiations are the most important things. As for the international community, I think China is a member of it. And of course, right now, the most important thing is to reduce the humanitarian crisis and also to provide more of the platforms for different sides to negotiate with each other.
So, Chuchu, does this, in some way, how do you think it's going to change or impact the meeting between Presidents Trump and Xi in just a few weeks? You know, the U.S. has used the threatened use of force to really take down leaders like Maduro, like the supreme leader of Iran, which have been nations that have been friendly to China. To what extent do you think that sort of level of welcome that President Xi is going to have with Trump, is that going to be somewhat fading or at least limited now?
Okay, so I think there are several very important points. First of all, when we talk about friendly countries, I would say a lot of countries are friendly to China, not just Venezuela and Iran, but many of them, especially after China proposed the Belt and Road Initiative in 2013. So there are a lot of friendly countries to China, and at the same time, I don't think that what is happening at the moment in Iran will deeply affect the relations between China and the United States, because I would say the relationship between China and the United States is structural, right? That is primarily depend on the interactions between these two big powers rather than what is going on in the other aspects. So I believe that, of course, this impacted, there are impacts on China's economy. If you talk about what is going on with regard to oil price, with regard to the shipping. But regarding China-U.S. relations, I think it depends more on how these two powers interact with each other. And so far, I have not received any message or news saying that this is going to affect Donald Trump's visit to China.
Is there any upside for China here, do you think, if the conflict does become more protracted, in as much as that it continues to distract the US and its efforts from its so-called pivot to the east militarily?
Right, that is a very important point. For instance, people are saying that, okay, right now, if we look at the new security strategy of the United States, a lot of people are arguing that the United States, it seemed, okay, so after it invests after it pours a lot of resources in the Middle East, and then in the next step, it is going to focus more on the Asia-Pacific region. But from my own perspective and based on my own observation, I would say the United States, first of all, it has never relaxed its involvement in the Asia-Pacific region, and Donald Trump has his own goals and strategy. So I don't think, okay, right now it means that, okay, if he reduces his resources in the Middle East will lead to increased resources being poured into the Asia-Pacific region. In fact, I would say the United States is currently seeking to maintain its own global hegemony at a low cost while simultaneously strengthening its presence in both the Asia-Pacific and the Middle East at the same time. So he is very ambitious and he wants to maintain his own hegemony in both places. But at the same time, he also does not want to bear a big cost for that. So what is he going to do? Right now, we can see that the United States is trying to get its allies from Europe, etc., around the world to share this cost.
Zhang, Chuchu, we're going to leave it there. Deputy Director of Center for Middle Eastern Studies at Fudan University. Thanks for the time. I just want to recap some of those numbers that came through here when it comes to the private gauge of these PMI numbers. So Rating Dog PMI manufacturing 52.1. Actually, a surprise to the upside here and really kind of beating estimates. We were expecting around a 50.2 sort of print. So 52.1 is quite strong. Services even stronger, 56.7 as well. So that also beat expectations and the median estimates there. So certainly the private gauge showing a very different sort of look to the official numbers there. Perhaps we'll see how that fares given, the Lunar New Year. There was a lot of, in terms of tourism and the like here. Maybe that's what is driving a lot of these sort of numbers as well here. But yes, better numbers in the private gauge. This is Bloomberg.
Taking a look at markets this morning, we are risk off in the session today. Unsurprising, of course, because you've got Asian equities very much in the red. But some interesting PMI readings out just in the last few minutes and showing a divergence. The official survey still in contractionary territory. Private one, a lot more positive. More ahead.
Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session here this morning. And yes, we are counting down to the MPC, right? So we're hoping maybe there's something there during these two sessions that could help these markets, because certainly we continue to see the sell-off continue for a third day here in the Asia Pacific. CSI 300 really kind of joining the fray. Relatively speaking, not doing as bad as what we're seeing in Korea. Look at Kospi. We're down another 6% today, Belle.
Yeah, these are huge drawdowns that you're seeing for the Kospi. Of course, you're still up, I think, around 30% year to date. So do need to keep it in perspective, but really seeing that tech story taking the brunt of this. Taiwan as well, the topics very much under pressure, but those tech-heavy indexes. It is also that story around oil that we continue to track. We have seen oil steadying somewhat, but the big sort of thing that traders are grappling with is essentially this U.S. escort plan for the Hormuz Strait. And we were talking with Stephen Sapchinsky, who leads our energy coverage in the last hour, and he was thinking initially this could be a big boon, and you might have seen prices really pull back. But I think just that flatness, you see there, just underscores how difficult this plan would be to implement as well. FX, it really is one of the big stories, and you're seeing a lot of carnage really across Asian FX this week. I think one of the worst weeks we've had in years so far. But certainly continuing to monitor that story around King Dollar, that haven trade, and the rally as well we've seen. But of course, bonds as well, just to note the moves that we're seeing there. Secondary to what we're seeing in FX, but still we actually still have seen treasuries declining again because traders are rethinking their bets around the Fed path for this year.
Yeah, certainly. Do they have the room to actually cut rates this year if we in fact see the inflationary impact from an oil price shock, right? And if this sustains further, does it make it even more complicated for the Fed here? And when we talk about what could happen, we heard from the likes of Minneapolis Fed President Neil Kashkari, who told the Bloomberg Invest event that the attacks on Iran make him feel less certain about rate cuts this year.
Now, with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. Right now, it's just too soon to know what imprint this has on inflation and for how long.
Let's get more on inflation fears and how that's affecting the outlook for monetary policy with our chief FX and rates correspondent Ruth Carson. Also joining us as regional stocks head for their third day of loss is our Asia Equities managing editor Lian Ting Tu. But Ruth, we can get started with you because, as we said, that story, it's very much around what we're seeing in terms of the dollar. What are you tracking so far?
If there are two words to describe markets right now in this instant, it's risk off. If it's risk off, what do you buy? And there is nothing that comes close to the King dollar. We're seeing it across virtually every pair out there. In terms of that haven bit, that real soul searching going on as to what you buy in times of stress, as we're seeing. So absolutely, the dollar's been having a fantastic time this week against every pair out there virtually. We saw the Korean won, for example, getting really hammered overnight. And this is just set to continue. All the traders that I'm speaking with, all the asset managers that I'm speaking with are just continuing to ask that question. When will this stop? What do we buy for safety?
Yeah, Lian Ting, maybe chime in here on the equity impact from this dollar strength. Is that why we're seeing more pronounced selling today? There's still a lot of people saying, there is still an opportunity to dip buy, but we're not quite seeing that in Asia just yet.
Yeah, definitely. On the other side of the dollar strength is Asia equities are getting under a lot more pressure. Dollar has been strengthening for a third day, and today we're seeing continued indiscriminate selling across a number of North Asia countries, markets, including Korea, Taiwan, and Japan, especially in the large cap space. The two big memory chip makers in Korea and a few big names in Japan and Korea are getting liquidated. I think people are just really taking some profit or chip off the table from these astonishing winners that we saw year to date in the so-called AI pick and shovel trade, which has put Asia not long ago at a record outperformance versus S&P 500. So it's natural that some chips are taken off the table. And if you look at some numbers, foreign investors have taken about $3 billion worth of equities out of Korea this week to date, and in Taiwan we're seeing outflows of about $3.6 billion. Indeed, some people are saying this could actually be a good buying opportunity at a lower valuation just because the AI beneficiary trade, the fundamental is very much intact, and this again is very technical type of selling that we're seeing in the market.
Yeah, and Ruth, I think that read across from the Korea story is very evident in the won, because when you see foreigners in particular fleeing the Kospi, it does bring the Korean won under pressure, and that's been evidenced by the drop.
Yeah, it was a pretty epic plunge, if I can use those terms. Just to put things into perspective, the won not only blew past the 1500 level, which is closely watched by officials as well as traders everywhere. We are looking at global financial crisis levels for the won. This at a time when, as we know, the Kospi has done well this year, albeit this week it's U-turn a lot of its fortunes. Now, do people see more weakness ahead for the won? Absolutely. If we look at option trading, for example, in the currency space, there's about a 36% chance that people are asserting that the won would likely trade around 15.50 per dollar. That's by the end of June. So the pain isn't going away anytime soon. Remember, the won is incredibly sensitive. People do care and use it as a bit of a risk proxy in Asia as soon as, bang, the bell starts ringing for trading. So definitely something to keep a very close eye on for not just risk sentiment, but as a bit of a bellwether for appetite for emerging market currencies here.
Ruth, the dollar yen's at 157. We're not seeing those sort of safe haven flows into this currency. Where does this leave the yen now?
The yen can't seem to catch a break. Seems to be the theme when I speak with a lot of investors in the market here. You would think that the yen would rally from a haven bit, but on the contrary, no. Now, it's important to remember that Japan imports, I believe, about 90% of their crude, of energy from the Middle East. So they're hit hard here by all this uncertainty. And do you really want to be buying a currency that has exposed large risks to the Middle East conflict? Probably not. So no, the yen is not exactly behaving like a haven. In fact, quite the opposite. People are indeed using it to fund some carry trades even at the moment. And is this set to continue? Probably. Does it also bolster the risk of potential intervention from authorities if the yen weakens further? Absolutely. That is also being debated in markets right now.
Lianting, I think it's a really, you could probably say every MPC or every 5-year plan is a high-stakes moment for China and the outlook for markets. But this one, of course, seems unusually high stakes when you've got, of course, these tensions in the Middle East or the protracted conflict that's developing there, plus Presidents Trump and Xi meeting in a few weeks' time. So how do you see the trading action for China in particular?
Yeah, right now I think it's just across the board risk off. I think a lot of people are just very much focused on this Iran tension. And within the China onshore space, you see a lot of rotation going from all those high-flying chip names to the shipping names, energy names. So that is sort of the frenzy of trading we're seeing right now. Yesterday, I think trading turnover in onshore equities hit another sort of 3 trillion yuan mark. And we see a 5% drawdown in the Star 50, which very much was focused on these AI optical names, chip names. So yeah, there's just basically a lot of sort of risk off and flight to safety. And safety right now to mainland investors is just really shipping and oil names.
All right, focusing on of course, the energy space there. Thank you so much, Lianting Tu, our Asia Equities Managing Editor. Also, our thanks to our Chief Asia FX and Rates Correspondent, Ruth Carson, both joining us out of Singapore this morning. Still ahead, we're live on the ground in Beijing as China's key political meeting of the year get underway. More on what investors should be watching out for next. This is Bloomberg. All right. Korea continued to see a bit of a sell-off here and really extending it. And we've actually entered into a technical correction in just 3 sessions. And really what's been driving that is, of course, some of those big heavyweights, right? SK Hynix, Samsung is down another 2%. But look at that Kospi gauge. We are down another 7.5% here today. So, the key beneficiaries of this whole AI boom, they seem to be the most vulnerable here this morning amidst kind of surging oil prices and really the Iran war that's really threatening the outlook when it comes to importers like Korea as well. So certainly that's one thing to watch. It really kind of changes the playbook quite a bit here, Belle.
Yeah, absolutely. And as you said, that Korean won story very much sort of also bearing the brunt of this amount of selling because foreigners are really leaving the market there. But let's also shift now because what else is taking place today is China's most important political gathering of the year that kicks off. Officials are set to unveil their blueprint for growth through 2030. Policymakers are under pressure to boost domestic demand and reinforce confidence. Our Chief North Asia correspondent Stephen Ingles has this report from Beijing.
Uncertainty once again dogs the outlook for Chinese leaders as they head into the annual session of parliament. Sure, by many metrics, China weathered the tariff barrage from the United States, achieving its annual growth target last year and finding leverage with rare earths and its own domestic AI development. But the Iran situation has thrown the geopolitical outlook into disarray, as the U.S. has for a second time, after Venezuela, taken out the leadership of a Chinese ally.
This is going to have a huge impact. It's opened the Pandora's box for whatever we're going to see in the future because all the countries are fear of this unilateral approach.
Chinese Foreign Minister Wang calls the attack on Iran unacceptable, and it's no doubt alarming to the Chinese military as well, which awaits word of its annual defense budget Thursday here at the National People's Congress amid an unprecedented purge of top generals. Now, it's a distraction as well when the task at hand here is really rebalancing and shoring up the domestic economy and further tariff-proofing it by boosting domestic demand ahead of Trump's highly anticipated, or at least planned, trip to Beijing at the end of March. American Manny Menendez has been doing business in China since U.S. diplomatic ties with the PRC were established in 1979.
President Trump is very transactional, so I think he will come looking for deals. I think there could be a large Boeing order I think there'll be increased in purchase of ag products, for example. China wants predictability and stability, but both countries want a stable economy. I'm expecting some really big things.
We remain constructive on China because of like AI adoption, and also as across different sectors, not just agentic AI, but into like physical AI as well, like robotics, and then also like semiconductors as well. So we'll need to continue to see the policy support from the NPC, whether they will be leaning towards rebalancing, and whether they'll be prompting for like higher quality growth and a focus on tech.
It has to stimulate the economy. The economy is clearly slowed. We have yet to see, the first robin of spring emerge from any of the stimulus that's been announced so far. I think it'll really be closer to May, June before we get a clear pickup in growth, but it will be there.
The Premier's growth target Thursday will give a good indication whether or not Beijing shares that optimism. Stephen Engel, Bloomberg News, Beijing.
Well, Eurasia Group expects Beijing to stick with the GDP growth target for this year of about 5%. Joining us now is their China director, Wang, joining us out of Singapore. Dan, it's good to have you. We talked to a lot of economists and your peers of yours that say maybe we might see that softer target of a range of 4.5% to 5%. You're still kind of sticking to around that 5% target. Why? And really, how achievable is that for next year?
I would be majorly concerned if the GDP target is set anything below 5%. Just by looking at all those infrastructure projects listed by NDRC on a provincial level, China can achieve the 5%, if not more. And judging by what's going on last year, export was systematically underestimated by the market. And this year, with this fiscal expansion of a lot of Western economies and military build-up, there is also a chance that export might overshoot. So I don't think there's a problem reaching the 5%.
Do you see any sort of rebalancing, though? And what is your outlook around that? Of course, last year, exports was really what led the Chinese economy. Consumers still weak. Is that calculus still the same for 2026, do you think?
The calculus would not only be the same for 2026, but all the way through 2030. The economic rebalancing is not happening towards consumption. There will be more infrastructure and domestic stimulus targeting construction, not for consumers. So what the market has been anticipating is a bigger boost for consumer market. The only thing that I see more fiscal allocation is happening is actually to boost fertility. So this is a national security issue as elevated by President Xi Jinping from 3 years ago. So demographic decline will attract more direct consumer subsidies, not other areas. There won't be a mass scale of cash transfer to Chinese families.
Some economists have said, this is the opportunity, though, to boost social spending, for example. Why do you think that's so, not the case? Or, why are you still hesitant to think that could happen? Is it something that's structural? Is it a cyclical sort of trend that you're seeing?
The intention is certainly there. The government has been stressing how important it is to provide full coverage for low-skilled workers especially. But there's a problem of resource allocation. There's only so much resources onshore. And with this kind of commitment of building up the modern industrial chain and also pursuing the high tech, the AI industry will absorb a lot of the new resources freed up from the fiscal revenue. And then the robotic industry, the drone industry, just lining up all those capital commitments, there is no chance that there even can be anything left over for mass boost for consumers.
We have the next 5-year plan coming out as well, likely toward the end of next week. What are your expectations around that? And do you think the timing of the meeting between Presidents Trump and Xi, that's of course still being planned, but the timing of that meeting, do you see it constraining the ambitions of China at all, given that they might want to be looking to appease Washington as well?
This will be a very interesting summit because I cannot see what the U.S. can possibly offer. Both U.S. and China seem to move beyond the tariffs. I have no doubt that President Trump will once again think of new ways, 301 investigations, 338 sanctions. The tariff will be higher than just 15%. But for China, the most pressing issue is actually more related with regional security, with financial security, and also the investment access to the U.S. market. So unless they can reach some bigger deal regarding China's investment in the U.S. that's not really scrutinized the level that it's being subject to now, or there can be some sort of tech export relaxation, I just don't see what kind of deal they can actually reach. But China's 15th five-year plan will stay intact. China is very long-term, very calculated. It's President Xi style. He's not opportunistic in this way.
You mentioned the five-year plan. I mean, obviously, there's been a big pivot or shift towards self-sufficiency, in key technologies, high-end manufacturing, the like. What does that roadmap look like to you in terms of what we could hear in the two sessions here? Whether it's state funding, are we likely to get any clues on that, or maybe even incentives in some of these industries?
Those industries are already getting the top level of policy commitment, including Chinese stock market. It is not a vehicle for Chinese households to make money. It's actually a financing vehicle for the high-tech sector. And when we think about what's happening in the stock exchange of Beijing and the star market in Shanghai, that's exactly the case. But for the Chinese government, it is also for the first time in the five-year plan history that they want to lead in a number of the fields. They always talk about catching up with the West in technology. This is actually the first time they're going to lead. And those future industries listed include the nuclear fusion, the 6G generation of telecommunication devices, and then the drones, the robotics. So they will get massive fiscal commitment from the government, but the problem now is the private funding is lacking. 90% of VC in Chinese market is still associated with the state, and that kind of reduced the efficiency of the use of the funds.
Dan, great to have you this morning. That's Dan Wang, the China director at Eurasia Group. And just as we've been discussing, continuing to monitor really all of this trading activity this morning. But the Kospi is taking the brunt of the sell-off in Asia today. And we actually do have a trading halt now in effect, both for the Kospi index, the sub-index, rather, the Kosdaq as well. But it's really Samsung, SK Hynix, again, that are leading that sell-off. But this is a circuit breaker in place for 20 minutes. More ahead. This is Bloomberg.
All right, we'll bring you an update on Korea coming up here. We're in the middle of a trading halt there in the Kospi Kosdaq here this morning. But let's talk a little more about private credit. Apollo Global Management CEO Mark Rowan says a shakeout is coming for private credit firms as concerns mount over defaults on loans to software companies. Now, Rowan told the Bloomberg Invest event that the impact will not be short term, emphasizing the importance of strong risk management.
The entirety of the companies that you see that are public today, everyone was 40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk.
That was Apollo's CEO speaking to our editor-in-chief in New York. But let's turn our attention back to what is the carnage, essentially, we're seeing on Korean markets in the session today, because this is actually setting us up for the biggest two-day crash going all the way back to the financial crisis. So we are in a trading halt that's in effect for another several minutes, but we are certainly seeing really the resilience of this bourse being put to the test. So we'll get more details on why we're seeing the extent of this selling. Some gainers there as well, you can see. More ahead.
Your global macro mover is looking like this here right now. It is looking like a sea of red across Asian equities here this morning. We are extending that loss and sell-off for a third straight day. We talked about that circuit breaker that was triggered for the Kospi as well as the Kosdaq. So we are in the middle of a 20-minute trading halt here right now after we saw those 8% losses there. We basically have seen the panic really sweeping across the Seoul there, the biggest two-day crash since 2008. We basically entered into a technical correction in just a matter of a few days. So there you go. It is some of those sort of AI beneficiaries that have been more vulnerable here. And you are seeing the likes of Samsung, SK Hynix really kind of dragging down Korea. A lot of questions, Belle, on what this means. Obviously, the U.S. dollar coming back in a big way might be impacting the whole EM story overall. And you got to wonder, right, is this going to be the turning point for markets like the Kospi, or are we just taking a breather before the next leg higher?
Yeah, well, we were speaking with Lian Ting Tu, for instance, who leads our Asia equities coverage, and she was saying some of the people they're speaking with are talking about this is a real buying opportunity, because you think about the Kospi, the strength of the Kospi this year has been very much predicated on the AI trade extending, and this is, of course, the company at the heart of it. It's the company, or the bourse rather, at the heart of the memory chip crunch as well. But you're seeing the likes of Samsung, SK Hynix really in the red in the session so far today. Of course, you can see there's really a lot of different statistically outsized moves across the screen. You're seeing that in equities, but you're seeing it in bonds as well. We have been watching treasuries, of course, the move there as traders reassess their thoughts on where the Fed heads next. But again, just diving further into what's happening in the Korea market, as we said, it is the chip names and the question around exactly where we go from here. Are we setting up for another leg higher, or is this sort of a turning point of what's to come?
It's interesting, right? Foreign investors for the past week have already been selling a record amount of Korean stocks. So, what is the playbook right now, right? Are the winners now the losers? As we face more uncertainty when it comes to the Iran situation here, obviously, when you talk about the EM complex, it's not just the dollar strength. A lot of these EM nations are also oil importers as well. So as they try to secure alternatives or supplies of energy, that certainly is going to be a key question on how economies like Korea are going to deal with this sort of situation and the supply shortages and what could come, disruptions of the like. So that certainly is going to be a key thing to watch here. Then there is the Fed discussion, right? When you have the likes of Neil Kashkari speaking at our Bloomberg Invest event and saying, he's also uncertain just, how easily the Fed can actually cut rates this year, right? You're starting to see the market reprice around, bond markets, which continue to sell off here as well. And really, does this mean a delay in cuts? Does it mean a prolonged pause? Or does it even mean the possibility of putting rate hikes back on the table if this situation continues?
Yeah, I mean, from that commentary, he was saying inflation actually was going in the right direction before the recent events. But we just still don't understand, of course, yet how long-lasting this conflict will be. We've heard lots of lines from President Trump. He's talking about U.S. security for ships passing through the Strait of Hormuz. Of course, the production output as well looks very different today than it has in recent past. You've got China's oil or energy capabilities that are a lot more diversified, essentially. There's a lot more different levers that they can pull on. And the U.S. as well, of course, a producer, a much bigger producer than it has been in years past. But
yeah, I think what adds to the complexity is that a lot of these AI companies do need cheap energy to kind of fund their growth ambitions when it comes to AI. So is there some sort of growth impact that could happen as well, not just an inflationary one? You throw up that board, too, on EMFX, right? We saw what happened with the Yuan. Was that a harbinger of what we're seeing of EMFX here in this part of the world getting really shellacked in some ways, right? The biggest plunge, or at least we're back to those levels that we saw in 2009 for the Korean won. You're seeing that with the Taiwan dollar. You're seeing that with even renminbi, now back above 690. So, how important is this sort of dollar move in the last few days? And really, where is that demand coming from here? The safe haven flows haven't been going to the yen. They've been going into the dollar, if anything. And so, we've been a horrible week when it comes to just emerging market currencies of late. Certainly, there's going to be a lot of questions about what this means for commodity markets, right? That dollar strength, does that in some way hurt commodities? So far, not quite, right? When you take a look at how oil prices are going, you take a look at how gold, gold actually did sell off just a bit yesterday, given the dollar strength. But, you have the likes of George Efstathopoulos from Fidelity talking about, look, the long-term prospects of gold are still there. They sold during the crash, just before the crash, their gold holdings, but they have been accumulating more as a dip buying sort of opportunity.
Yeah, and just sort of thinking more about the dollar again, and safe havens generally, I do think it really is putting those question marks over that dollar debasement trade to rest for now.
For now, yeah.
Yeah, because it's very much that king dollar story and is what has been really reigning supreme here. But let's get more on this now and bring in our MLive strategist, Mark Cranfield, in Singapore for us this morning. So, Mark, of course, it's really Korea bearing the brunt of the pressure today, but why are we seeing the extent of the selling in that market in particular, and what is it reflecting to you?
We're entering a phase now where, especially for cross-asset traders, it's really just a question of trying to liquidate what you can, where there still may be some profits left in the trade. So everything here is vulnerable, which has had a really good run over the past few weeks or months. So obviously Korean equities have been outstanding for the past few weeks. So there's certainly going to be a lot of positions built up there. And we started to saw gold began to crack last night. It's doing okay today, but you could see it was a pretty decent sell-off overnight. So again, that was people reducing positions there. It's interesting you talk about the US dollar, because clearly coming into this period, people were mostly underweight the US dollar. There've been a lot of selling, a lot of positioning of traders being short the US dollar, so they have to reverse that pretty fast. And if you look across the currency space, one that's potentially vulnerable here is the Australian dollar. That's had a great run over the past several weeks. It hasn't really shown any big cracks yet, but clearly if this starts to spread where it just becomes a liquidation mode, where people just really trying to cash in anything they possibly can, then Korean stocks is just one. There's going to be several other assets which are going to come into play here. And even you see it to some extent in the Treasury market, because people came into this week actually pretty bullish on Treasuries. They're expecting the Federal Reserve to lower interest rates more. They weren't expecting a big spike in oil prices, and now people are getting pretty defensive on that market as well. So it's all being exaggerated because a lot of positioning as we came into this week was just simply the wrong way around.
Ruth Carson was talking about the clear big mover and winner is the dollar. How sustainable are these moves, Mark?
As long as you have a crisis building out the way it is, people will obviously gravitate towards the most liquid currency in the world, which is still the US dollar. It's got a lot of flaws. It's by no means a perfect asset by any means, and yet it is the most used currency in the world. It comes into play for most asset classes. A lot of things are priced in US dollars, whether it's commodities or bonds, or all kinds of things are using the US dollar. People are very comfortable with the fact that they can carry it anywhere in the world and get transactions done using that currency. So for the time being, there's no better alternative. It might not be everyone's favorite, but in a time of crisis, people want the US dollar because it has a track record of performing. If you look back at the global financial crisis, the US dollar was the best performing currency at that time. And there's a lot of question marks about others. When you look at the yen or the Swiss franc, which in the past have been havens, they're just not doing their job very well. So people are just gravitating back towards the US dollar.
At the same time, there's a story that's very well read this morning on the terminal, which is Goldman Sachs' David Solomon says he's being very surprised by by the benign reaction that we're seeing in markets, what he considers to be benign reaction in financial markets to the conflict. Do you see that as well, that a sense of complacency at all? Of course, it's sort of a bit jarring when you think about how Asian equities are trading today.
Yeah, I guess he doesn't have a live feed of Korean stocks. I mean, maybe he should take a look at the Kospi. It doesn't look very benign to me, the reaction, or even the jumps in the oil market, the rapid reversal in bond markets as well. I think it's a little bit of. I think traders are taking that with a large pinch of salt. It doesn't look very benign. Maybe there's something he's looking at that I just can't see. But to me, there is anything but a benign reaction. Doesn't mean to say it can't go further. I mean, if this conflict in the Middle East lasts, let's say, worst case scenario, it lasts for a few months, then certainly financial markets could get into a much worse situation than we're seeing now. If it all peters out in a few days, of course, then markets can start to recover. But for the time being, there's already some very strong reactions, and we're only in the first week of the conflict, so it certainly has the chance to get even worse than it is now.
I can't imagine, Mark. What else is on your radar here? What are some of the next sort of pressure points to watch out for?
Well, one of the interesting things is we're in the first trading week of the month, which is a bit. It just tells you that we started the year pretty well. January and February, if you were in most asset classes, it would have been a pretty decent start. And it shows that people didn't really trim positions too much going into the end of February. So they're starting the month here with relatively big exposure to markets, been jolted by what's happening in the Middle East. So when you consider that it's happening so quickly in just this first week of the month, this could really get pretty nasty. We could have all asset classes are in play here, whether it's currencies, bonds, equities, commodities, everything is shaking at the same time. It's almost a situation of a genuine financial crisis, and yet we still haven't got into the quarter end yet. That pressure also will mount on people. Don't forget, Japanese companies, it's the quarter and the financial year end in Japan. That also has an impact on markets as well. The yen has been relatively stable to some extent, but as we get closer to the end of March, if markets are still in this kind of unstable situation, Japan really would have a big role to play, because people will have to do some serious book squaring up for the end of the Japanese year. So we've got a couple of weeks to go before that problem hits, but watch Japan. If you think it's bad now, things could get really exciting towards the end of the month if Japan is involved.
Mark, great to have you with us this morning. That's our MLive strategist, Mark Cranfield, there. And of course, one of the key markers who are watching it today is the Kospi. We've actually just had it coming back online, resuming trade after a circuit breaker has been lifted. We are seeing it still under pressure, down 8% in the session so far today. But putting us, of course, we've seen that technical correction coming into play as well. Stocks down more than 10% now since their high early this year.
Yeah, we'll see how this plays out now that things have opened up and the circuit breaker has been lifted. But as Mark just mentioned, right, there could be still more pain to come. This is still a market that is about 20, double-digit gains for this year. So it is maybe a positioning, but it still might need a bit more washing out before things settle. You take a look when it comes to some of the winners, though. It is clearly some of the energy plays when it comes to defense stocks, for example, shipping. So there are still some pretty outsized gains for the likes of Korea Petroleum Industries. S-Oil for the likes are seeing about 20% gains right now. But then again, really being overshadowed by some of the sell-off that we're seeing when it comes to some of the AI names and the rest of the Kospi names there as well. Another news to tell you about here, which normally would be a big story for us on the China show, but has been really in some ways overpowered by all the stories that we're seeing when it comes to Iran, the sell-off, is the likes of New World. So seems to be some questions and issues over this deal with Blackstone. So the talks with the property developer have hit a roadblock, according to our sources, because the Cheng family is reluctant to give up control. So Blackstone has proposed injecting about $2.5 billion into a special purpose vehicle to become the largest shareholder of New World, while the Cheng family would invest $1 billion to $1.5 billion. But right now, the stalled talks do highlight the challenge when it comes to some of these global buyout firms facing in securing control when it comes to very much these sort of family-run companies in Asia. What we're hearing reportedly that the Chang family reluctant to cede power. So that's the latest there. New World shares are down some 4%. We'll have more details coming up. This is Bloomberg. All right, back to our breaking news in the last couple of minutes there. Bloomberg sources are telling us that talks between Blackstone and New World Development have stalled, with the billionaire Chang family that controls a Hong Kong property developer reluctant to give up control. For the details, let's bring in our Bloomberg Asia Finance Investing and Wealth Managing Editor, Lulu Chen. So why this roadblock? What do we know so far?
Yeah, a couple of sticking points. So people familiar have told Bloomberg News that the talks between New World and also Blackstone have stalled. A key tension is the control over New World. So the billionaire Chang family owns about 45% stake in that property firm, and they effectively run the company. Another key point is that the rent over 11 Skies, that fancy mall near the airport that visitors see when they come into Hong Kong. So New World originally was supposed to pay about 30% of its gross revenue. If you tally up the figures, that's about 1.8 billion Hong Kong dollars a year. So that rent is still there that they're supposed to pay to the Hong Kong government starting 2028, and they have not managed to unwind that agreement. The original proposal was that Blackstone would inject about $2.5 billion into an SVP and become the largest shareholder, and the Chang family would inject $1 billion to $1.5 billion.
So what does this mean for the challenges that, sort of speaking bigger picture here, but that face global buyout firms that are maybe looking to enter into assets in this city? And as well, what are the options that the Chang family has from here?
Well, New World managed to refinance of $11 billion last year, but they're not out of the woods. Longer term, they still need a solution, which is why they're talking to other investors as well. Bigger picture, it is a setback for global buyout firms looking to venture into this space that is so far pretty much predominantly controlled by billionaire families, Hong Kong families. And one of the key things for these families has always been the control over their prized assets.
Yeah. For any buyout firm that wants to come and rescue the property market, they're going to be hitting some roadblocks here. What else do we need to look out for New World moving forward here now?
Well, their debt issue is still there. In their earnings last week, they reported significant losses. Net gearing ratio is still at 90%, according to BI analysts. So that's significantly higher than other property developers. So these are all issues that they need to deal with longer term down the road.
All right, Lulu. Thank you, Lulu Chen there, our Bloomberg Asia Finance Investing and Wealth Management Editor.
Yeah, let's also get some other world news that we're tracking this morning, because Pakistan says it's in no hurry to end its military operation in Afghanistan. A senior Pakistani security official says the duration of the operation depends on actions on the ground by Afghanistan's Taliban government in rooting out militant groups. Dozens of people have been killed. That's after the Taliban launched retaliatory attacks last week against Pakistan's airstrikes on militant targets. Chinese Foreign Minister Wang says, or is calling on Israel rather, to pursue an immediate ceasefire in Iran. He spoke with his Israeli counterpart on Tuesday and said Beijing will play a constructive role in easing regional tensions. Wang also urged Israel to take steps to ensure the safety of Chinese citizens and entities.
All right. We're still grappling with quite a bit of massive sell-off here across Asia. In the meantime, we're still dealing with a lot of disruptions. If you've been traveling, obviously, I'm guessing you've been feeling some of these as well. Airlines around the world are suspending more flights to additional destinations across the Middle East as the scope of the war expands. Now, Cathay Pacific has now canceled flights to and from Dubai and Riyadh until March 14th, so another 10 days or so. Let's get to our Danny Lee, Asia aviation and transport reporter. And it's not just Cathay. We're hearing much more.
Yeah, we're hearing scores of airlines who are pushing back flights. Cathay is one of the airlines that have pushed back flights the longest based on their own risk assessment of the situation in the region. We've got the likes of Finnair in Europe who are pushing back flights to the end of the month. But all of this adds up to a total of cancellations now, which has topped more than 12,000 flights being axed overall so far since this war has started. So there's pretty widespread disruption. And at least for now, the flights, with airspace closed, priority is really being given to people to be given get out of the region. And we have seen over the recent days the likes of Emirates and Etihad Airlines resuming some flights to get people out. So there is still a broad effort by the airline industry to get people out, not get people to transit and whatnot. So in the next few days we'll see how things fare, but clearly for now there's a pretty broad disruption overall.
And the Middle East is such a big transit hub as well, particularly for people travelling from this part of the world, Australia, to Europe in particular as well. So how do the airlines in this region then, are they capitalising on this? I'm thinking of course, Cathay, Singapore Airlines as well, but others.
Yeah, you do see the Asian airlines in prime position to take advantage, whether it be just because of the way in which they have similar business models to the Gulf carriers. And the Gulf carriers, operate around 10% of international capacity, which has just been taken out at a stroke. So, and you do see the Asian airlines primarily benefiting, but it's all soft. It's all little comfort when you see oil prices, jumping, and so everyone's eating higher costs at the moment.
All right, Danny, thanks so much for joining us. That was our Asia aviation and transport reporter, Danny Lee, there. And our subscribers can get more on the Iran conflict. That's in today's Big Take, looking again at the energy story, but how the Iran war oil shock is threatening to unleash a wave of global inflation. For terminal subscribers, the function is NI Big Take. It's also available on Bloomberg.com.
All right, we're checking markets here right now. We are continuing to see pretty big moves here when it comes to Kospi after returning from that circuit breaker that was triggered in that trading halt. We have come off, I have to say, some of the initial sort of losses here, but we're still talking about 7% downside here when it comes to the Kospi as well as the Kosdaq here today. Hong Kong and China looking, relatively speaking, a bit better. Hang Seng is lower by about 450 points. We got plenty more to come. This is Bloomberg. We've been trying not to call it panic, but I think in Korea you could say in some ways there is a bit of panic selling here right now. After you talk about the biggest two-day losses we're talking about since 2008, it has entered into a technical correction, and we've come back from that trading halt, still seeing some pretty pronounced moves to the downside here. So it does seem like it's a bit like catching a falling knife here this morning when it comes to Asian equities. A lot of it has to do with, of course, the dollar story, given how much it has come back in the last 2 days as well. Then again, there's still a lot of uncertainty about really how long these, we talked about airline disruptions, talking about oil and supply disruptions and the like. So still, I think investors are still looking at right now that knee-jerk reaction is, of course, to sell before you actually buy on these dips.
Yeah, and you can see that there's that it's the tech-heavy story, and you take a look at those other very tech-heavy benchmarks. You've got Taiwan, for instance, Japan. I mean, it's very broad-based selling that we're seeing, but still you've got those North Asian markets that are really taking the losses. It is, as you said, that dollar story, and it's certainly been a very bad start to the week for EMFX, and we've been talking about the dollar that's just been on a gain over the past few sessions, but traders really moving back into that. It's taking its position as the safe haven trade.
Yeah, and you're seeing quite a bit of weakness when it comes to the renminbi 692 levels. Korean won is coming back, but we saw quite a bit of a plunge yesterday. So it really is more of a catch down story for the rest of EMFX and what they're seeing with the won. Taiwan dollar is above 31 here right now. Thai baht is also weakening to that 31 level as well. So we'll see, of course, how U.S. markets and Euro markets, but India markets could be quite vulnerable as well, just given, of course, their dependency when it comes to the oil side of things.